The more interest rates rise, the more rapidly the rise, the greater the probability that the bubbles crash, and the sooner that happens.
The land of Arcadia.
Well, hello there, my friends. Chris Marcus here with you on Friday, April 6th. And today, a video about a little financial market secret that just might change your life forever. Although, in all seriousness, that is kind of what's happening in the bond market. And we're going to cover why we could be witnessing what in due time will be one of the most historic events in financial history. And certainly, if you understand what's happening, I think an incredible opportunity not only to not get pummeled like so many were back when the housing bubble or dot-com bubble or Black Friday or any of these other spectacular money printing fueled bubble crashes, how things ended up. And I've talked a lot about interest rates lately, but I thought today would be a good day to explain why, interest rates, this, that, up, down, whatever. Why does it really matter? So let us first dig in and take a look at our interest rate chart, where rates have risen a little bit this week. Basically, at a Fed meeting 2 weeks ago, or was it last week? I think it was 2 weeks ago. Fed indicating possibly more hiking than expected. In either case, that they're going to continue as expected, despite that we're finally seeing trouble show up in the other financial markets with the higher rates. So rates have kind of stayed a little bit lower, but as you can see, if we take a look at the 1 month chart, here we were up by about 2.9%. And I think the 21st was the day of the Fed announcement. So it's kind of unusual that it sank quite a bit after that, although again has risen this week. And for the most part, there's a whole bunch of things that could account for that. Although personally, what I think is pretty glorious is that you don't necessarily have to know every dip or spike of 5 or 10 basis points, because a lot of these things, there's always money flows, especially today where we see how quickly money changes hands in some of these markets. So not really a huge move, yet what I like so much about the whole situation is you can see where these things are headed, leave things that have really high probabilities of good outcomes in the long term. And we're going to explain why, despite what's happened in the past month, you can see really since September, when we're down at about 2.05%, rates have gone up quite a bit, although still well below historical norms, or certainly anywhere near what would be a normal market-determined interest rate at today's environment. And why, again, does this matter? Here you can see this morning, non-farm payrolls increased by 103,000 in March versus 193,000 jobs expected. So at least, again, factor in, we're looking at numbers that are not really in any reality close to measuring the actual labor force, because as John Williams of Shadow Stats and others go into detail pointing out, a lot of these formulas, these are government numbers, so things are not, they're a little skewed often, but still to the degree that people are going to still react to some of these numbers, whether I think it would be wise or not, that's a pretty big miss there. And then you can see also the monthly reading was a huge slip from the 326,000 reported in February. Again, you don't want to read too much into some of this data. I mean, again, it always gets revised by, let's see if there were any revisions here so we can take a look, because each, all right, here we go. In addition to weak March growth, January's total was revised down from 239,000 to 176,000, though February got a boost. So you get the idea. Again, why I'm a little skeptical of the numbers I mean, the formula changes a lot. So you hear people comparing it to the unemployment rate of the Great Depression, yet it's a different formula because they omit people who have given up looking for work because they've been out of work so long. So either case, so is this a direct result of the higher interest rates? A little early to tell, but it's the kind of thing that you would expect. How is the market reacting to this? Down 450 points as trade worries continue to rattle Wall Street. So there you go. Then here, of course, we have Trump's tariff gamble with China could be catastrophic for the economy, the GOP, and his presidency. Because I think last night they increased the tariffs. If I remember the chronology correctly. Oh boy, we have a CNBC exclusive with Steve Mnuchin at 1 Eastern. Wow, we're going to have to tune in for that. I'm sure that'll be a hoot. But I believe Trump did the first tariff. A day or so later, China responded. Then there was a Wall Street Journal headline I saw that maybe they were going to get together and settle things before melting down the economies. And then it looks like instead Trump has slapped on another layer, which if you look at things on the surface, from any sort of rational economic perspective, if this were really what is going on, would be kind of a disaster. At the same time, interest rates are rising. You see the economy weakening. Here, you have largest trade deficit. Housing market is heading south. This was an article over on Investment Research Dynamics with my friend Dave Kranzler, who is also out here in Colorado. So again, all the things that you would expect as interest rates go up, for the same reason that you got the opposite effect in the short term, which turned out to be more than the short term, of when rates were lowered, when the government was buying all of this debt that none of the other banks would touch back in 2008. Not the government buying it, but the Federal Reserve creating credit to say, we'll take that on our balance sheet. But this was debt that not even the banks would touch. And what have you done? You've just borrowed more and printed and papered over more, which creates that effect that things seem better in the short term, except the whole point is that when you unwind that, that's when you run into trouble. Mnuchin said he is in communication with China about tariffs. Objective is not a trade war. Well, that's great news. We'll see how Steve does with that one. Maybe he can audit the Chinese gold reserves too, since he did such a thorough job in Fort Knox. But again, in the same way that printing money and creating credit gives, these temporary effects, when you remove that, my guess is that a lot of these banks are going to become insolvent, and it wouldn't take significantly higher interest rates. And when you think about what would a normal interest rate be now, I mean, God only knows. It really doesn't exist in a sense, because the system would collapse anywhere before you reach that. And to put that into perspective, back in 1980, when people were getting worried about inflation then, and Paul Volcker raised interest rates to 20%, we can't even crack 2% at the same time that, and remember that all these quantitative easing programs that were sold as temporary, again, I'm not hearing many others mention this, but Jerome Powell said that when he talks about normalizing the balance sheet or undoing that, he's not talking about taking it down to where it was before the crisis. He's saying maybe we'll get down to 2.5 to 3 trillion in the next 3 to 4 years, which of course is going to make it even harder, because at the same time, if rates are going up and you're seeing the effects of that, again, are we seeing the bubbles crash just yet? I would say that's still a little bit early to tell. But certainly if the bubbles are beginning to crash, which is what you would expect if rates continue to go up, then these are the exact signs that you would see. So a lot of this, it gets confusing because things are distorted. And I find it personally unfortunate, as someone that studied finance in college, and just there was something that I remember when I was early. I took a field trip to one of the exchanges, and then watching movies like Trading Places. There was always something exciting about, in the same way that it's fun to play poker, and especially if you see it as a skill. So it was a field that was drawn to, yet seeing how distorted it is, how much manipulation there is in the markets, personally was at a time disappointing. I guess then you learn to see things as they are. And in either case, it's hard to see often in the short term, yet when you put these pieces together, it doesn't have to be as complex as it's made out to seem. And perhaps the simplest way of putting it is that I believe that there are massive bubbles in the stock, bond, and real estate markets. And the more interest rates rise, the more rapidly they rise, the greater the probability that the bubbles crash, and the sooner that happens. So 10 minutes in, or however long it is, that's the point. Because in the end, with all these things going on, you can think of it, and that simply, and again, refer back to the housing crisis of a decade ago as a simple metaphor. You had all of that excess revealed when Greenspan started raising rates. That's why the banks were going insolvent. That's why they needed to be bailed out. And everything is just massively bigger this time around. So, God, could you imagine what would happen to these banks if you had 20% interest rates like back in 1980? So anyway, that is why we have things like cryptos, which are continuing to take a pounding, which certainly is, if you're holding cryptos or have money for expenses or for some reason need to sell, is not so ideal. Yet to the degree, if you have money to invest or are thinking about the bigger trend, in the end, you have these bubbles that are being exposed, and the cryptos as essentially an alternative system to what's collapsing. And again, my favorite way of looking at it these days is that you see up here in market cap just around 250 billion. And in the world stock markets, I saw an estimate that there's about $76 trillion. So just think about it. If all these things with the interest rates that we talked about continue to play out in that manner, and money starts to leave the stock markets as it is doing with trade wars, and all the other things that are going on. So if even 176 of that money went into cryptos, that alone would be a quintupling of the market. If you took $1 trillion out of the stock market, which certainly, distortion aside, there's a lot of reason to believe, or that, let me put it another way, I'm not in a rush to go buy broad cap stock markets at this point. So that's what I like about this, where to me, if I continue looking at the adoption of the cryptos, continue seeing the trends in the financials, then I'm willing to make a long-term bet, so that whether the price of cryptos is volatile, which I expect it will be. We've been mined that, everyone's getting excited because it went to 20,000 and then down to 6,000. If you had a regular stock that went from $6 to $20 and then down to 10 and then back down to 6 again, might be viewed a bit differently. But again, if you have a system that can't exist, and really to me, it comes down to do you buy into cryptos as a legitimate purpose, as playing a legitimate role and a legitimate function, which is more a technology question than an investment one, because if you can answer that part, I mean, if Litecoin is going to be adopted, for example, at Starbucks or Amazon, which has not happened, there continue to be rumors. Um, if you believe that, then given these other dynamics that are taking place, it seems to me the investment decision then becomes easy, similar to how silver, as beaten up as it is. I mean, I was writing about it this week where it's interesting. I mean, obviously, I sit here and write all day the reasons why I think silver is massively undervalued. Um, and, I read as much as I can find. I listen to YouTube silver podcasts on double speed. And really out there searching often to see, is there something I'm missing? Is there another perspective that might show me something different? And I was noticing how it's like, not only don't I often hear a counter argument to what I write, but it's actually rare to hear. I don't remember the last time I've heard someone say, wow, silver's a great sell at $16. Let alone a legitimate case of why silver would go a lot lower. If not for any other reason, forget all the money printing and all that, but just the fact that you're basically at what it costs to get the metal out of the ground. So I guess that's why, to me, and all these things that I explain and talk about in these videos, where the crunching the numbers isn't the hard part, but really accepting, wow, could there be in our lifetime not living with the dollar currency system as we know it? Keep in mind that historically, it's a general rule of thumb in the economic community that when you have a paper fiat currency, tends to have a shelf life of about 40 years. And if you measure from when Nixon removed the U.S. from the gold standard back in 1971, we're about, I guess, 47 years now. So for whatever that's worth, but it's really like I remember when I was still on Wall Street and I started asking some of the people I worked with after the housing bubble collapsed, and I just started reading the people that had seen it in advance, because there were a few, and they were all the same ones that were talking about gold and silver and the credit cycle and why mortgages couldn't continue to go forever and what happens when you print money, and then what has to happen as certain as gravity when you unprint the money, which is what we're seeing now. And I remember it was just fascinating. The only counter argument I ever heard, I remember talking to my old boss, and he just said, well, things like that don't happen in the U.S. I guess we'll see. Certainly, it appears to me that this is beginning to happen in the U.S., and that's why there is the interest in the cryptos. Certainly a lot of volatility, but to me, when making a decision, whether you're holding cryptos or thinking about buying or selling, my perspective is look at what these were designed to do. Is there a need for that? So if you read the white paper for Bitcoin, and whether it's Bitcoin or others, certainly, I certainly actually subscribe that there are flaws, not the right word, but there are ways in which, for example, Litecoin serves as a potential really day-to-day transactionary currency more than Bitcoin. But that aside, just that the general theme was designed, in my opinion, by someone with insight and seeing the problem with the current system, seeing the problem with the printed money, designed clearly as a response. So certainly to me, if you see that there's a crypto that you think fills what is a glaring need, do people keep wondering, what's the inherent value? What's the backing? Well, if it's secure and it can't be printed, that's the value. Think about it like this. The dollar has lost, I think it's up to 99% of its value since the Fed was created, if you measure it against gold. Certainly, if the gold market didn't have a massive amount of short paper sold that I don't believe there's metal in existence to deliver, then the gold price would be even higher, meaning that that measurement, maybe the dollar would have lost, if you back it out, 99.9% of its value. But when you see all these mansions and banks and yachts and things and wondering where the money has come from, it's coming out of the currency. It's not the easiest thing to see, but that's how, whether a tax is a more direct way of seeing it, but inflation, you can think of it like a tax. So if we've had the dollar system and 99 point, or I'll call it 98% just to be conservative, has been taken away, and you have something that can serve that role of transacting as money, yet the people get to keep 99.9% and maybe pay some small fee in comparison, just like a basic transaction fee, rather than, similar to the way that you pay tax. So to me, if you believe that we are seeing a shift, then that makes it an easy no-brainer to buy at anywhere near these levels for both cryptos or silver. And lastly, when in doubt, maybe this weekend, another great time to watch The Big Short, which really helps put this into perspective, because again, when you look at the basic facts, to me, it seems pretty clear where it's all going. It's really more of a mental challenge, requiring a little patience, and also just realizing that life changes, that nature is still bigger than a bank or a government. And I think there's going to be a lot of good things happening, a lot of shift more towards honest commerce and things being a lot less expensive. I mean, imagine if everyone just, think about it a lot. If the dollar's lost, let's say 98, 99% of its value, if you're getting 1% of what you actually earn, imagine if everyone got if you were getting 10%, if they had left a few more crumbs for the rest of us, so just imagine that you whatever salary you're making right now, multiply it times 10, and you can leave the price of, whatever you're buying the same. But now your salary, multiply it by 10, and imagine that's only a tenth of what you've earned. Or, even imagine if you went higher than that, which is what is hard to see often, but why I feel it's important to point all these things out, and why, if we really are seeing the currency fail, then that would explain how you could still see much higher prices for cryptos or gold and silver. By all means, if you think the current system is great shape, good to go, then probably not the best idea to buy cryptos or metals, but I can only share my perspective. We'll see ultimately if I'm right. I can tell you with certainty that is my genuine opinion after 11 years on Wall Street and doing a lot of writing, thinking, and researching about it since then. So with that said, leave any questions you have below. Hit the thumbs up button. Let's boost our channel. And at least hopefully this is helpful and can be of help to others that are wondering what's going on and what to do. With that said, have a great weekend, and I will see you next week. Thanks.
The land of our